Hey everyone, this is Gaines with Duval Financial Group. Yesterday, I was doing a review with some of our clients and was super excited to hear that they were going to possibly be refinancing their house. In this interest rate environment, what an amazing gift to have an interest rate lower than 3% for the lifetime of your mortgage. And then they told me that when talking to their mortgage professional, they had been considering doing a 15-year mortgage. I 100% understand the appeal to that and the excitement about getting your house paid off in 15 years. But I cautioned them and I said, let's look at the difference between a 30-year and a 15-year. So in our firm, we are super focused on cash flow, right? We want to create the least amount of obligatory payments a month for our clients and have the most cash flow coming in. So cash flow from their jobs, so their income, cash flow from their rental properties, or cash flow from other vehicles that we help them with. So what I want to do now is I want to show you the difference between a 15-year mortgage and a 30-year mortgage and potentially doing something with the difference in those potential payments. So I'm going to share my screen now and I'm going to show you a website called bankrate.com. Bankrate.com is a great website to find interest rate calculators, mortgage calculators, car loan calculators, whatever. So in this example here, I'm not using this to say you should do a 15-year or you should do a 30-year. That's up to you and your financial consultant that helps you with those things. I'm just going to show you some simple math and give you some things to ponder when you have that decision. Again, interest rates are so low right now, refinancing makes sense for most people. And when you look at the even lower interest rates of a 15-year mortgage, it can be very sexy, and I get it. So here's a 30-year mortgage for a $200,000 loan at 2.99%. That's the interest rate that these people were getting quoted. They were going to refinance approximately $200,000. So I took out no homeowners insurance and no property tax, no HOA. So all we're looking at right here is principal and interest. So if they do a $200,000 loan for 30 years at 2.99% interest, their payment for principal and interest would be $842 a month for the next 30 years. Now, the loan officer that they're working with told them that they could actually get this down to 2.35% if they do a 15-year mortgage. So now we're running the same amount, $200,000, in a 15-year mortgage at 2.35% interest. So that's a super low interest rate, and their house would be paid off in 15 years, but now their principal and interest would be $1,319. So the difference between doing a 15-year mortgage, $1,319, and a 30-year mortgage, $842, is $477 a month. So by doing a 30-year, they have an extra $477 a month cash flow for whatever they want to use it for or need to use it for. And they're in more control of their money by having that lower amount. But if they do a 15-year mortgage, they are guaranteeing, assuming that they make this payment every month for the next 15 years, that their house will be paid off in 15 years. So now what I'm going to show you is, what if they do a 30-year mortgage at $842 with a little higher interest rate, but then they take the $477 a month and they just put it into a simple savings account. So one of the vehicles that we use generally returns 4 to 5%, tax deferred, tax free, the whole separate subject. But I'm just going to use 4.5% in this example here. And I'm going to also go to Bankrate and I'm going to do a simple savings calculator of $477 a month for 15 years at 4.5%. If they get 4.5% every single year, and it won't be exactly 4.5%, but if they were to get 4.5% every single year or every single month on $477 a month going in for 15 years, they would have a total of $122,325. So now the question is, okay, I'm 15 years into my 30-year mortgage. I've saved $122,000 in another vehicle, some form of a savings account. What is my mortgage? How much do I still owe in 15 years? So let's fast forward to May of 2036. This is the schedule showing the balance going down right here on the loan. And in May of 2036, they would still owe $122,000. So if they had done the 15-year mortgage, they would have owed zero in May of 2036, right? Because it would be paid off. But if they do the 30-year and they take that extra $477 a month and put it in a vehicle getting 4.5% a year interest, they would have $122,000 in their savings account, and they would still owe, they would have $122,000 left on their mortgage that they owe, and their savings account would also be $122,000. So now what that did for them is that gave them the ability to have more cash flow. Maybe there was a month or two that they could have used that extra $477, or maybe they're putting it into a vehicle that's getting better than 4.5%. But at the end of the day, they have less of an obligation to the bank on a monthly basis. Now let's take this a step further. I'm going to take this same idea, but I'm going to lower it to 4%. If this particular person is only getting 4% in the savings vehicle, and they're putting in the $477 a month, which is $5,724 a year, and then in 15 years, instead of paying their mortgage off, they start pulling out $10,000 a year, which is $877 a month times, or $842 a month, their payment, times 12. They would have enough money in this account, only getting 4%, to pay off or to continue to make their mortgage payment. So arguably, it's still paid off in the same amount of time, but they were in more control of more of their money. Now let's get crazy. Let's say that they get 6% return. Now, not only did their money grow considerably higher, and then they started using their account in year 15 to pay their mortgage payment for them, they would still have $90,000 left in that account when it's all said and done. So again, what I'm showing you here is not to say you need to do a 15-year mortgage, you need to do a 30-year mortgage. I don't even do mortgages. I have relationships with lots of loan officers that I trust and I refer clients to that do a great job for them, and they would work that out with you on the difference between the 15-year for you, the difference in the 30-year for you. But in our firm, what we help people look at is the cash flow opportunity. Where can I put my money that I'm 100% in control of? If I'm giving that extra $477 a month to the bank to pay down my mortgage, I'm not really in control of that. And if all of a sudden I need a little extra cash flow, I can't just call the bank and say, hey, can you drop my payment down to $842 a month for a little while because I'm having some hard times? Generally speaking, the bank's going to say, no, and we're going to come take your house after a little while. So that's the answer to the question that you've got to ask yourself is, do I want to be in more control of more of my money? Or maybe I just am not good with my money and I want to be forced to make that extra payment so that my house is paid off in 15 years. But I would tell you this, if you're not good with your money, the last thing you want to do is have a higher obligation to somebody else. You know, it says in Proverbs that the borrower is slave to the lender. Whether you believe in the Bible or not, I think that there's super powerful wisdom there in that verse. The borrower is slave to the lender. When we owe somebody money, we are a slave to them. Now, in both of these situations, we owe the bank, whether it's a 30-year or a 15-year, money. But in the 30-year, we owe them less on a monthly basis, and we're in more control of our money, and we still get to pay off that loan in 15 years if we choose to do that. Hope this is great information for you. Have a very blessed rest of your day.